Great, thank you. Well, I've really enjoyed. We've gone from the first panel with a kind of macro level discussion of shadow banking and Bill Gates' £20 billion personal hedge funds to really the kind of everyday discussion of household debt. So it's really interesting to see that kind of contrast. So thanks very much, Jonna. And how are we going to do it? Jan, are you moving to the table? Yeah.
Mumble from behind it. Somewhere here. This should be mine.
So, Jan Toporowski will be speaking on, if you're ready, the financial functions of private equity.
Where do I press?
That little screen at the bottom.
Sorry?
Right down at the bottom of the bar.
To the left of that
one.
Yeah.
That one?
Yeah.
I'll talk about the financial functions of private equity. In other words, the functions that I see private equity as performing for the financial system. In particular because, it's relevant to this discussion because the discussion that we had before coffee, because private equity is sometimes considered to be a part of the shadow banking system. Arguably it isn't, it's doing something else, and I'll explain what that something else is. But I think if you unpack what private equity does, it's also possible to understand also how the nuts and bolts and the mechanisms that are going on in the financial system. So what I'll talk about just now are the financial operations of private equity firms. Talk about how private equity is linked to capital market inflation or inflation of the capital market. Then the link with the financial crisis, and then what I think is the true function of private equity, which is as a form of liquidity management. How much time have I got? Because I can see
20 minutes?
Sorry?
20 minutes?
20 minutes, okay. I'm sure I won't need that. There's not really that much to it. If you look at what private equity firms are, they're limited partnerships that run private equity funds. It's important to distinguish between firms which have a durable existence. They're set up as limited partnerships so that they don't actually have to disclose all their financial operations. And they are they actually run, they will run a succession of private equity funds into which the partners, not the partners from the private equity firm, but usually, the private equity firm might be one of the partners, but there will be other financial institutions will invest a certain amount of money, usually a minimum of about £1 million, more likely around 10 million. And this is for a fixed period of about 10 years. So a private equity firm may have a number of these funds, maturing at different times. It may, at any one time, let's say now, it might be just starting one, which will last for about 10 years. It might have one which is 5 years old, so it will mature in 5 years' time. It might have one which is 7 years old, which will mature in 3 years' time. If the partners agree, then they can have 1 year extensions. And then after 10 years, the fund returns the money with any profit that's accrued in the fund. The actual I should have said that some private equity fund gets 1 to 2% fee. The firm gets a 1 to 2% fee, plus what's sometimes what's called the carried interest, of 20% of the profit. This is supposed to give the private equity firm what investment bankers call skin in the game. They're an incentive to make as much profit as possible. So let me go on to their financial operations. So you have a fund which has been set up in which partners are putting money. What do the private equity firms do? Well, what they do is they gear up. They borrow as much as they possibly can to extend the financial resources that they've got from the partners that have put money into the fund, and then they buy companies. When I say they buy companies, they will buy out the shares of companies. So you have even some well-known household names like Hilton Hotels or Boots, the pharmacy, are owned by private equity firms. At the end of the term of the fund, that is when the fund matures, the companies are sold at a profit, usually through an initial selling the company back into the stock market. And the proceeds plus the profits are returned to the investors in the fund, less fees and the carried interest. So the focus of private equity is very much on their exit strategy. How are they going to take this? How are they going to convert this very, very liquid investment of a company back into cash and distribute the money? And I'll explain to you now how it's done. Let me just say that what I'll show is I'll show in tabular form how equity firms operate. I'm leaving out household finance, just government finance and private foreign capital firms. Not that these aren't important; they are important. But there's these simplifying assumptions in the sense that they wouldn't make any difference to the analysis. It would just make the analysis, or it wouldn't make any difference to the conclusions. It would just make the explanation considerably more complex. So let's start off. If I put forward this a kind of a starting position where essentially you've got an economy in which there are banks, non-financial firms, and financial institutions. Let's remember that private equity, a lot of what we're talking about is characteristic of economies and financial systems that are dominated by financial institutions. I mean, even with respect to Fotis and his elite of ultra high net worth individuals, actually the vast bulk of financial assets are owned by financial institutions. So I'm assuming that there's financial institutions with, on their liability side, £700 worth, however valued, of liabilities, whether these be insurance liabilities or pension fund liabilities. And these are represented by £600 worth, or millions, of shares, £100 worth of deposits. There we have the non-financial firms. They're financed with those 600 shares, £600 worth of shares, against which they have typically for firms £600 worth of equipment, stocks, and various other things. And obviously these £100 deposits, they're the liabilities of the banks, and let's assume the sort of starting, the virtuous, as our starting point, the virtuous end point of positive money, that all this is in reserves, so nothing is nothing can go wrong. But just simply it simplifies the analysis. So let's say that in the previous version, private equity was nothing. It didn't exist. It didn't have a balance sheet. The balance sheet starts when financial institutions invest their some amount of money that they have, their bank deposits, in private equity, so that their bank deposits are now replaced by a holding in a private equity fund. There's that holding. There's the £100 of deposits. The rest stays the same because the private equity firm hasn't started doing anything yet. The third position, in the third position, the private equity firm is gearing up. Essentially, it goes to the bank and borrows £500 or $500 million dollars or whatever in whatever is the currency unit. There's the loan. There's the loan as a liability, which is the asset of the bank. So the banks now have, in this respect, positive money are correct. The banks now have £600 worth of deposits. These are represented by £600 worth of deposits here, or held by the private equity firm. The financial institutions' balance sheet, total amounts stay the same. £600 worth of shares, £100 worth of private equity, £600 of shares, £600 pounds of the non-financial firm's balance sheet stays the same. Okay, so the fourth position 4. The private equity firm buys company shares. That's the starting point. You buy company shares. Who has them? Well, they have them. They're held by the financial institutions, as most shares are. So the deposits go back to there. The private equity firm's balance sheet is now getting more complex. It's about £100 of liabilities to the financial institutions. There's the private equity. There's the private equity investment. It's borrowed £500 or £500 million from the bank. On the asset side, they've got shares. For the non-financial firms stay the same. They're now, ownership has transferred from financial institutions. They're now owned by the private equity firm, but the balance sheet stays the same. The amounts of the balance sheet stay the same. As I say, the banks have now expanded their balance sheets, considerably. Various strategies that could be done at this point. Usually, quite often in the what happened in the past is that the non-financial firm would be asset stripped. They're essentially finding assets which have been undervalued, selling them off. That's a common way, or that used to be a common way at times when asset inflation was on the go. I show something different, which is what you do with this borrowing. A rather more complex operation whereby you actually oblige the firms, you transfer the loans from the private equity firm to the non-financial firms. You can do in part it's possible to do this because once private equity owns the non-financial firms, they have a common balance sheet. In a sense, it doesn't matter on who's formally responsible, but a standard way is actually for the non-financial firm to go to the bank, borrow money, and use the borrowed money to repay the private equity firm's or its shareholders' loans, its owners' loans. But of course, it creates a deeply imbalanced structure because essentially the non-financial firms are technically insolvent. Their liabilities are greatly in excess of their assets. But the counterpart of this is that private equity firms are already greatly in profit, have the excess assets. And and of course this, from an accountancy point of view, this doesn't really matter because there are one accountancy unit, private equity firms own the non-financial firms. The nice thing that you can then do is start sweating the assets. This is again a bit the terminology of private equity firms. Sweating to repay, sweating the firms to repay the loans, essentially by borrowing, forcing the firm to give all the liquidity that it can to repay the firm's debts, taking income to repay debts. I don't know, making everyone work harder and longer for less money is another cutting costs, all this kind of thing. We should remember that the fund has 10 years to do this. And then what I've shown is that in effect they've managed to repay the loans. They repaid the loans. The banks have put the repayments into the reserves. What happens on the private equity side is that the private equity is now massively in profit. Financial institutions are in balance. Position 7 is that the firms are returned to the market and private equity profits are ready for distribution. Well, what returned to the market simply means that they're sold back to financial institutions. which I've indicated here. The private equity firm returns £100 deposited with them. There's now, the fund has the remaining 500 ready for distribution as profits, ready to distribute to the partners in that fund. Those are the financial institutions. So this essentially is the way in which private equity firms work. Now you can, if you look at the literature around this, you find that there's a lot of literature which complaining about this sweating of the assets, underinvestment in real fixed capital, and so on. All of this is absolutely true, and outrageous and all the rest of it. But I want to look further at what's the connection between these kinds of operations and what's happening in the financial markets. And finally, to do this, you need to understand what the relationship is with capital market inflation. Capital market inflation being where financial institutions, in particular immature pension funds, inflate the equity market because they're buying shares. So you get a rising equity market. And now, if you have a rising equity market, then this is really what might be called feather bedding for the private equity funds. You buy a company, sit on it for 10 years, you sell it again at a higher price. What does this mean? It means that if the equity market is rising, the private equity firm does not need to sweat the assets so much, because they can get a capital gain on the return of the firms to the capital market. And this is why the complaints about private equity really came to a head just before the financial crisis, when the capital market was virtually flat, and private equity firms were really, really driving companies that they owned to get the liquidity out of them. The connection with the financial crisis is really that there emerges much before the financial crisis. The problem in the 1990s was that pension funds started to mature. In the US, where you have funded pension schemes had been established much earlier, maturity came earlier, but from the 1990s onwards, the capital market really inflated much, much less. And with the capital market inflating much, much less, financial institutions found themselves with portfolios on which the capital gains were not as good as they had historically been. And therefore, private equity was now much more attractive to institutional investors. So the boom in private equity starts off in the 1990s. And of course, this was accompanied with a forced reliance of private equity on the sweating of financial assets. The problems of the financial crisis created for private equity were very, very serious. First of all, the liquidity of the capital market which meant that you could no longer make easy money from selling companies back into into public ownership through the stock market. And secondly, the freezing of bank markets, which made it more difficult for private equity firms to gear up to buy companies. The way private equity responded to this was by sharing of company purchases between funds. Various different funds would come together to buy out a company, and this was this started being a feature around the turn of the century. They started going into other into other assets. Distressed assets started being a feature of this. Distressed assets, i.e. assets that you could buy that were undervalued because for some reason they were illiquid, but if you rearrange their balance sheets, you might be able to sell them some more. And something else, which was that they started selling companies from one fund to the next, where you can see that there's the scope. If a fund is about to mature, it has assets which it can't sell into the capital market. The obvious way around this is to sell them to another fund which is being started up. So there's and of course the actual relations between all this is very, very non-transparent, because these the private equity firms are partnerships. They don't publish the data on what they're doing. So let me come round to my conclusion. Let me look at what their financial function I see as a part of liquidity management. What they do, what private equity is doing, is essentially putting liquidity into the capital market by expanding the liabilities of firms to banks. Secondly, they offer institutions a more liquid way of equity investment, because if an institution holds shares, the shares don't have a fixed maturity, whereas a private equity firm has a 10-year maturity. So it's a much more liquid way of investing in shares. You've got some kind of assured liquidity and hopefully profits as well. And the other thing is that, and for the funds themselves or private equity firms, they have security from withdrawal of investors' funds, of investors' money before the funds mature. See, this is a fundamental difference between private equity and hedge fund. With a hedge fund, you can take the money out when you want to, when you think you've made enough profit, or if you're worried about whether you'll make a loss, you'll pull your money out. With a private equity firm, during that 10-year period, the managers of the fund have no liquidity risk. They don't need to hold liquid assets against the possibility of withdrawal of funds, because the funds can't be withdrawn during that period. So my conclusion is that this is something unusual is happening here. Equity is supposed to provide firms with cheap long-term financing and funding for internal liquidity. The standard reason why firms issue shares is that they they issue shares to repay bank borrowing or to replenish their liquid reserves that they've used up in the course of investment. What private equity does is it actually chips away at this. On the one hand, it provides equity markets with assured liquidity. It's actually it's taking borrowed money, putting it into the market for long-term securities, making those markets more liquid. But this is at the expense of the long-term financing and the internal liquidity of the non-financial firms. In a sense, in practice, what private equity does is it cannibalizes that internal liquidity. It uses that internal liquidity to put into the capital market in order to, it's a kind of artificial stimulant or inflation factor in the capital market. So that's it.
Thank you.